Every government swears it wants a strong currency. They talk about confidence, stability, and national pride. They praise the power of their money on the international stage, and they stand behind podiums telling you that a strong currency is a reflection of a strong nation. But watch what they do, not what they say. In the real world, governments and central banks quietly panic when their currency gets too strong. They complain that their exports are suffering, their factories are closing, their workers are losing jobs. They warn that the economy is losing competitiveness. And behind the speeches about responsibility and strength, they start playing a very different game. They start trying to make their money worth less. Not once, not by accident, but systematically over the years, sometimes decades. And they're not alone. Other countries see this and respond. They don't want to be the only ones with a currency that's too strong, so they join in. They cut rates. They expand their balance sheets. They intervene in foreign exchange markets. They quietly push their own money downward too. That's the paradox. If every country is trying to weaken its currency to gain an advantage, if everyone is trying to export their way out of trouble, how can they all win? The simple answer is they can't. Someone pays, someone absorbs the cost. And most of the time, that someone is you. This is competitive devaluation. This is Beggar-Thy-Neighbor 2. 0. This is the currency wars historian, where money, power, and history collide. And nothing is ever as simple as it looks. Devaluation is not just a technical policy lever, it's a weapon. It's a silent tariff imposed on your savings. It's a subsidy for exporters at the expense of everyone else. It is a way to take the pressure of the crisis and push it somewhere else, onto trading partners, onto future generations, onto ordinary citizens who don't understand the game that's being played over their heads. The phrase beggar-thy-neighbor sounds like something from social media, but it comes from the ashes of the Great Depression. It describes a policy where governments try to escape their own economic pain by making everyone else poorer first. You try to save your own economy by dumping your problems onto your trading partners. You weaken your currency to steal demand from abroad and hope no one notices what you've done. Today, the tools are more sophisticated. The language is softer. The charts are prettier. The press conferences are more polished. But the game has not changed. To understand Beggar-Thy-Neighbor 2.0, you have to go back to the original software. Back to the 1930s, when global trade collapsed, money broke, and governments reached for the easiest lever they could find: cheapen the currency and hope someone else takes the hit. In the early 1930s, most major currencies were chained to gold. Currencies promised redemption in a fixed amount of metal. This was supposed to guarantee stability and discipline. Governments, in theory, could not just print at will because every new unit of currency was tied to a finite resource sitting in a vault. Then the Great Depression hit. Trade collapsed, banks failed, unemployment exploded, politicians were desperate. Their first instinct was tariffs. Raise import taxes, protect domestic industries, and force citizens to buy national. One country raised tariffs, then another retaliated, then another. World trade spiraled downward. The global economy's arteries began to clot. When tariffs weren't enough, governments turned to the exchange rate. If you couldn't outcompete your neighbor through productivity, you could cheat by changing the rules of the game. You could devalue your currency, make it cheaper relative to others, so your exports looked like a bargain and your imports became more expensive. You could boost your industries by stealth and push some of your internal pain outward. That was the original beggar-thy-neighbor policy. Try to save yourself by impoverishing your trading partners. Britain left the gold standard. The pound fell, giving British exports an immediate price advantage. Other nations watched their industries suffer and knew they couldn't just sit still. They followed. They cut ties to gold. They devalued. One after another, currencies were marked down. Everyone tried to gain an edge. Everyone tried to offload the pain. For a brief moment, each devaluation looked clever. Exporters cheered. Factories saw new orders. Politicians claimed success. But then everyone else copied the strategy. And when everyone tries to out-cheapen everyone else, the advantage disappears. What remains is a world of weaker currencies, damaged trust, and savers who have been quietly sacrificed. The short-term benefit is visible. The long-term cost is hidden. That's the first lesson of competitive devaluation. It works until everyone does it. Then it stops being a strategy and becomes a trap. So why do governments keep doing it? Because the logic is seductive. When your currency falls relative to others, your exports become cheaper abroad. Your tourism looks attractive. Foreign investors see bargains. At home, imports become more expensive, so people substitute for domestic goods. Local producers feel supported, and politicians measure success in visible, immediate metrics. More exports, busy factories, rising employment in key sectors. But under the surface, something else is happening. Your citizens holding cash, bonds, pensions, and savings in your currency are being quietly taxed. Every unit they hold now buys less abroad. The foreign products they rely on, energy, food, medicine, equipment, creep up in price. If your country depends heavily on imports, especially essentials, devaluation is not just a clever policy. It is a dangerous game. You're making an unspoken decision. Some industries will be helped and everyone else will pay. Exporters win. Importers lose. Debtors breathe easier. Savers get crushed. In the short term, it feels like growth. In the long term, it feels like erosion. The world tried to learn from the chaos of the 1930s. After World War II, the Bretton Woods system was designed to stop wild currency swings. Most currencies were pegged to the US dollar. The dollar was pegged to gold. On paper, this was stability, fixed exchange rates, predictable trade, no more random devaluations. In reality, the old impulses never went away. Governments still wanted export growth. They still feared unemployment more than inflation. They still looked anxiously at their neighbors and thought, if only our currency were a bit cheaper, we'd be fine. Under Bretton Woods, you couldn't easily change your exchange rate without causing a political storm. So instead of openly cutting your currency, you ran inflation hotter than your trading partners. If your prices rose faster while the exchange rate stayed fixed, your goods became less competitive. Pressure built up like steam behind a locked door. Eventually, you were forced into a formal devaluation or a reset. By the late 1960s, the United States was running large deficits, trying to pay for both guns and butter, war and welfare at the same time. Dollars flooded the world. The gold behind them did not. Other countries began to doubt the promise that every dollar could be converted into gold at a fixed price. The anchor snapped. When the U.S. closed the gold window, Bretton Woods died. The world shifted to floating exchange rates. On the surface, this was about flexibility in market forces. In practice, it reopened the old game in a more subtle form. Manage your currency to serve your interests and hope everyone else adapts. The beggar-thy-neighbor didn't disappear. I put on a suit and learned central bank jargon. In the 1980s, the United States struggled with growing trade deficits. Japan and West Germany were booming, exporting cars, electronics, and machinery to the world, especially America. U.S. politicians argued that foreign currencies were undervalued and that American workers were paying the price. The response wasn't a tariff war this time. It was a deal. At the Plaza Hotel in New York, major economic powers met and agreed that the dollar was too strong. They committed to act together to push it down. Through coordinated intervention, they sold dollars and bought foreign currencies. The dollar fell sharply. It was a managed devaluation of the world's reserve currency. Officially, this was about correcting imbalances and easing trade tensions. Unofficially, it confirmed something deeper. Exchange rates were now openly treated as policy tools. They were no longer neutral outcomes of supply and demand. They were levers in a negotiation between states. It was an early modern episode of coordinated currency adjustment that showed just how much power governments have over the value of your money. Then came 2008. A global financial crisis brought the system to the brink. Banks failed, housing collapsed, trade imploded. The response was unprecedented. Zero interest rates, then negative rates in some countries, and wave after wave of money creation with a harmless-sounding name, quantitative easing. Officially, this was about stabilizing finance, saving the system, and supporting demand. Unofficially, it also did something else. When you flood an economy with newly created money and keep interest rates near zero, your currency becomes less attractive to foreign investors. The reward for holding it shrinks. Capital looks elsewhere. Downward pressure builds on your exchange rate. If one country does this alone, its currency weakens. Its exports become more competitive. Its stock market often rises as cheap money flows into assets. If many countries do it at once, they end up in a strange equilibrium. Everyone is trying to avoid being the one with the too strong a currency, the one that bears the weight of everyone else's easing. Central banks will tell you they do not target the exchange rate. They talk about inflation expectations, employment mandates, and financial conditions. But the side effect is unmistakable. Low and negative rates combined with money creation are a form of quiet, rolling devaluation. One finance minister in an emerging economy called this a currency war. The phrase stuck for a reason. Beggar-Thy-Neighbor too. Zero doesn't always look like an official midnight announcement slashing the value of a currency. Sometimes it looks like a decade of near zero rates. It looks like swelling central bank balance sheets. It looks like polite statements about enhancing competitiveness and supporting growth. The weapons have become more technical, but the target is the same. Someone else's balance sheet, someone else's purchasing power, someone else's savings. When every major power tries to prevent its currency from becoming too strong, a few predictable things happen. First, savers are punished. Bank deposits earn little or nothing in real terms. Government bonds yield less than inflation. Pensions strain to meet promises. The traditional safe places to store wealth quietly deteriorate. Meanwhile, the value of assets, real estate, stocks, rare collectibles, soars under the influence of cheap money. If you already own those assets, you ride the wave. If you don't, you watch them race away from you. The latter is pulled up a little higher. Second, inequality widens. Those closest to the financial system, those with access to credit and capital, see their wealth multiply as asset prices rise. Wages lag behind. The cost of housing, education, and essentials grows faster than paychecks. The gap between owners and workers stretches wider. Third, emerging markets get trapped in a cycle they did not design. Many governments and companies in developing countries borrow in foreign currencies, especially dollars, because the terms are cheaper. When global easing floods them with capital, their currencies strengthen, credit booms, and their economies overheat. When sentiment shifts, capital flees, their currencies sink, and suddenly their foreign debts become a noose. Their devaluation isn't a clever policy, it's a crisis. The theory behind floating rates and independent central banks is that each country can manage its destiny. In practice, when everyone uses the same tools at the same time and reacts to everyone else, you get synchronized booms and busts, asset bubbles, and waves of instability that ignore borders. Underneath all this lies a simple game theory problem. If only one country devalues, it can gain a meaningful advantage, at least temporarily. If every country devalues together, whether openly or through low rates and inflation, no one gains a sustainable trade edge, but all share the side effects. Distorted prices, broken signals, fragile systems, angry citizens. It's a prisoner's dilemma played with trillions of dollars. Each player has an incentive to cheat, to ease just a bit more, to let inflation run just a bit hotter, to push rates just a bit lower, to keep their exporters happy and their unemployment numbers calm. No one wants to be the outlier with tight money and a strong currency while everyone else prints and cuts. So they all move in the same direction. Slowly, reluctantly, then habitually. And as long as inflation seems contained and people keep trusting the system, they get away with it. But what happens when confidence wavers? What happens when people begin to doubt not just one currency, but the entire structure of promises that money represents? What happens when savers look at a world of competitive devaluations and ask, if every government is trying to make my money worth less over time, where do I store value? That is where the risks of Beggar-Thy-Neighbor 2. 0 become existential. The endgame of repeated devaluations, layered on top of enormous public and private debts, is not just a world of mildly weaker currencies. It is a world where trust in money itself becomes negotiable. History offers a few consistent lessons about what survives in such environments. Scarce, real assets tend to hold their value better than paper promises. Land, productive businesses, vital infrastructure, and essential commodities don't vanish when a currency is marked down. Their nominal prices may swing violently, but their underlying utility remains. They are tied to real human needs, not just to numbers on a screen. Diversified currency exposure matters. If all your savings, income, and bets are trapped in a single national currency, your fate is tied to that government's decisions. If your assets, skills, or income streams touch multiple currencies, sectors, or countries, you are harder to corner with a single policy move. Skills and productive capacity are more resilient than any balance in a bank account. A currency can be devalued overnight. A promise can be broken in a single announcement. But the ability to build, repair, teach, design, grow, and solve problems is much harder to devalue. In every period of turmoil, people with portable skills, flexible thinking, and the ability to create value for others find ways to adapt, while those relying solely on nominal savings face the storm head-on. And awareness is the most underrated protection of all. The highest cost of Beggar-Thy-Neighbor 2. 0 falls on those who don't even know the game exists. If you believe that strong currency speeches guarantee your purchasing power, if you see low interest rates as a pure gift, if you think money printing is only about helping you, then you are exactly the kind of citizen these policies depend on. They rely on your trust. They rely on your inertia. They rely on you not noticing that the rules are being gently but constantly adjusted underneath your feet. The lesson of competitive devaluations is harsh. In the 1930s, Beggar-Thy-Neighbor policies destroyed trade, deepened the Depression, and helped fuel extremism. Today, the tools are disguised in the language of sophisticated economics. The same impulses operate through central banks instead of gold parliaments and midnight decrees. The intent is wrapped in phrases like supporting growth and maintaining stability. But the logic has not changed. When leaders are cornered, they often choose the path that spreads pain outward and forward in time, rather than facing it honestly today. They sacrifice savers to save borrowers. They weaken currencies to protect exports. They quietly tilt the board and then ask you to be grateful for the stability you are given. Competitive devaluation is not about making everyone richer. It is about deciding who absorbs the cost of past decisions, who pays for the debt, who pays for the misallocation, who pays for the crises that were papered over instead of solved. Most of the time, those decisions are not explained plainly to the people who bear them. So the question is not whether Beggar-Thy-Neighbor 2, 0 exists. It does. You are living inside it. The real question is whether you choose to understand the game you're in or allow it to be played over your savings, your work, and your future without resistance. Because when money becomes a weapon, ignorance is not neutrality. It is surrender. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.